Today, I'm sharing with you the truth that banks or mortgage lenders don't want you to know, the hidden interest payment that's triple your actual mortgage payment. Shocking. Welcome to this informative and educational video where I'll reveal the truth about mortgage interest and show you how to pay off your mortgage early. With the strategies I'm about to share, you can save a significant amount of money by reducing the interest you'll pay over the life of the loan, and finish paying off your mortgage years ahead of schedule. My name is Ernest. I am the founder of multiple technology businesses with few apps. I also have 7-8 figures online businesses. I hold an MBA from Durham, and am a chartered accountant with over 2 decades experience. My goal is to share my knowledge to help you improve your finances and achieve your financial freedom goal, just like I've done for myself and my family. Understanding how money works can greatly enhance your ability to build wealth. This works in any country, language, culture, and place. Understanding mortgage interest. How mortgage interest is calculated. First, let's talk about how mortgage interest is calculated. Knowing this is crucial for understanding how the strategies I'll share work. When considering a mortgage, most people focus on the monthly payment. Can I afford it? Is the usual question. While this is important, the interest rate on the loan is equally significant. A higher interest rate means you'll pay more over the life of the mortgage. But how much more? The interest on a mortgage is often hidden within the payment structure, making it less obvious just how much you're paying in interest. Let's break it down. Principal and interest. Each monthly mortgage payment has 2 parts. Principal. This is the amount you borrowed and need to repay. Interest. This is the cost of borrowing money, calculated as a percentage of the principal that you haven't yet paid back. For example, if you borrowed $250,000 on a 30-year mortgage at 4% interest, you would end up paying $180,000 in interest over the life of the loan. At a 6% interest rate, you'd pay $290,000 in interest, and at 8%, a staggering $410,000 in interest. These figures are eye-opening, demonstrating just how costly interest can be over time. Creating a mortgage amortization table. To illustrate this further, let's create a simple mortgage amortization table. This table shows all the mortgage payments and interest charges over time. Assume a 30-year fixed-rate mortgage of $250,000 at a 7% interest rate. In the first month, the interest is calculated as follows. The annual interest rate of 7% divided by 12 months gives a monthly interest rate. Multiply this by $250,000, the initial loan balance, to get the first month's interest. If we continue this calculation for each month, without considering payments yet, the table shows the interest accruing on the remaining principal. By adjusting the monthly payment to ensure the loan is paid off in 30 years, we can determine the correct payment amount. Calculating the monthly payment. Using trial and error, we find that a monthly payment of $1,663.26 is required to pay off a $250,000 mortgage at 7% interest over 30 years. This payment includes both interest and principal. In the first month, $1,458 of the payment goes toward interest, with only $205 reducing the principal. As the loan progresses, more of each payment goes toward the principal, reducing the interest charge over time. Over 30 years, you'll pay a total of $348,750 in interest, nearly doubling the amount borrowed. This example shows the importance of understanding how interest accumulates over time. Strategies to pay off your mortgage early. Now that we understand how mortgage interest works, let's explore 5 strategies to reduce the interest you'll pay and shorten the loan term. Strategy 1. Make extra payments. Making extra payments toward your principal can significantly reduce your mortgage term and interest costs. Example 1. $100 extra per month. By paying an extra $100 each month, you can reduce a 30-year mortgage to approximately 25.2 years, saving $66,767 in interest. Example 2. $250 extra per month. Increasing the extra payment to $250 per month pays off the mortgage in just 20.6 years, saving $126,200 in interest. Strategy 2. One-time lump sum payment. A single large payment can also make a big difference. Example, $5,000 one-time payment. If you make a $5,000 lump sum payment in the 24th month, The mortgage term reduces to 28.3 years, saving $28,730 in interest. Strategy 3. Bi-weekly payments. Paying half of your monthly mortgage payment every 2 weeks results in 26 payments per year, equivalent to 13 monthly payments. Example: bi-weekly payments. This method pays off the mortgage in 23.7 years, saving $86,500 in interest. Strategy 4. Using a line of credit to pay an extra $10,000 every 7 to 8 months will help you pay off the mortgage in about 7 years instead of 30 years and save you hundreds of thousands of dollars in the process. Strategy 5. Refinance to a shorter term. Refinancing your mortgage to a shorter term, such as 15 years, can save you a substantial amount of interest. However, this strategy requires higher monthly payments, which may not be feasible for everyone. Example: refinancing to a 15-year mortgage. If you refinance a $250,000 mortgage from a 30-year term at 7% interest to a 15-year term at 5% interest, your monthly payments will increase. However, you'll pay off the mortgage in half the time and save a significant amount in interest. The power of extra payments. All these strategies involve making extra payments toward your principal. By reducing the principal balance, you reduce the interest charged, accelerating the payoff process. Summary table. To illustrate these strategies, I've created a summary table comparing a 4% interest rate mortgage and a 7% interest rate mortgage. The table shows the impact of different strategies on the mortgage term and total interest paid. Feel free to pause the video to examine the table in detail. It's a powerful visual representation of how small changes can lead to significant savings. Atomic habits of mortgage payment. Summary table: 4% versus 7% interest rate. Final thoughts. Understanding how mortgage interest works and implementing these strategies can save you a substantial amount of money and time. By making extra payments, whether regularly or occasionally, you can significantly reduce the interest you pay and pay off your mortgage faster. Remember, the key to these strategies is consistency and starting as early as possible. The earlier you make extra payments, the more you save in interest. If you found this video helpful, please give it a thumbs up and subscribe to my channel for more financial tips and strategies. Your support helps me continue to provide valuable content.